Grail Advisors is going to launch 4 new funds on the New York Stock Exchange tomorrow. Grail Advisors says that these will be the first single manager actively managed ETFs using traditional stock picking methods. Morty Schaja, formerly of the Barron Funds and now the CEO and managing partner of RiverPark Capital. He's the manager of the new funds, and he joins us now. Morty, welcome, and thank you very much for coming in. Talk a little bit about ETFs versus mutual funds. For those that don't know the differences, in fact, you've discussed in the past that there are some inherent, or you believe in, advantages to ETFs over mutual funds. Why is that?
Well, mutual funds are basically a 100-year-old product, and a fantastic product. And I've lived most of the last couple of decades in that industry. And but we're living in a world now where most markets trade 24/7, and mutual funds, frankly, trade once a day. They trade at 4 p.m. So if you want to buy a mutual fund at 11 o'clock in the morning, you've got to wait until 4 o'clock. So there's this concept of, is it really as liquid as we've thought? Probably not. Mutual funds are also not as transparent as you'd think. You basically
when you say not as transparent, in what sense? Meaning in the holdings of the fund, or
yes.
Why is that?
Well, we issue quarterly reports on mutual funds, so we tell you what's in a mutual fund on a quarterly basis, typically with about a 45-day lag, where an ETF, generally speaking, tells you what's in it every day.
So if they make a change one day over another day, they're actually going to let the investing community know about that.
You'll know exactly what's in that ETF every day. So you've got liquidity, you've got transparency, you've got more tax efficiency, just through the nature of the way you can exchange baskets within an ETF, which is a little technical, but it's more tax efficient than a mutual fund. And frankly, you've got lower fees. So not surprisingly, in the index world, which is where ETFs started, ETFs have been gaining share on index funds from the mutual fund industry. And that'll continue. I mean, it's basically a superior product than the mutual fund for exactly the same investment. The breakthrough, and the reason why we're so excited at RiverPark, is that we're now involved in something new and different, which is actively managed ETFs. So this is a mutual fund. It looks like a mutual fund in the sense of that you've got a portfolio manager making buy and sell decisions every day, but it trades on the New York Stock Exchange just like an ETF, like a passive ETF. So you have the benefits of both worlds. You have the benefits of the active mutual fund world, where you still want to get state-of-the-art, the best managers you can.
Right, you've got the expertise of a real person picking, or in this case, selecting the stocks.
Exactly. But the vehicle is a superior vehicle. It's an ETF. So,
now there are 4 of them that are launching tomorrow, trading on the NYSE. Now, these are the actively managed ETFs that you're going to be in charge of.
Right. So so basically, we're launching 4 ETFs tomorrow: a growth fund, a focused large cap growth fund, 20 to 23 names, and that'll be managed by one of our partners out of St. Louis. And we've got 2 sector funds: a financial sector and a technology sector. So for people that are looking for exposure to those sectors, here's a way to gather that exposure, but with the expertise that we offer, which is we're going to pick which stocks we want to own within those sectors.
All right, let's talk about the individual ETFs. I was going to say funds, but the individual ETFs.
All right. Exchange-traded funds.
Exchange-traded funds. Agreed. Now, the growth fund, the first fund, the growth fund. What kind of characteristics can you tell us about in terms of what would go into that fund? I mean, since it's brand new.
Well, we're long-term investors, so we're looking at companies with the mindset that we want to own stocks forever. If the market gives us an opportunity to do that. Our typical holding period will be 3 to 5 years. We're buying stocks that we think have unbelievable growth characteristics, companies that
would it be, let's say, in the technology field, in biotechnology?
Technology will be 20 to 30% typically of the portfolio. We're looking for companies that we think can double in size within the next 3, 4, 5 years. But we're not momentum players, so we tend to be value-oriented. So we're looking for opportunities to buy these great businesses at what we think, frankly, is an attractive price.
When you talk about attractive price, I mean, given the fact that we've had this sell-off today in the market, the Dow down down 203 points, rather, is this the right time? I mean, to be launching a group of exchange-traded funds such as this, or why specifically now? I guess.
Well, I mean, I don't want to be sitting here predicting the market overall.
That's okay. You can do it if you want to, but we won't hold you to it.
Right. Listen, I believe that over the next 3 or 4 or 5 years, you'll look back at this period of time and you'll say, this was a good time to invest. But more importantly, it's bottom up. You've got to find the right investments to make, the right stocks to buy. And hopefully that's why shareholders will come to people like ourselves or other money managers to do the stock picking.
What kind of benchmarks or what kind of measures will you be using so that individuals or indeed institutions that take a look at, let's say, this growth fund, they'll be able to measure? Are they matching something? I mean, are they going against a specific benchmark, or is it this alpha that we all hear about, this idea that you want just absolute returns uncorrelated to something else?
Well, it's a little bit of both. I mean, we're not isolated from the market overall. So there is a benchmark in the sense of that we're looking to beat the averages. The reason why someone's going to come to us instead of investing in an index fund is because they think we're going to beat the average. So the growth fund, we expect to beat, the Russell growth or the S&P 500. The focused large cap growth, where our partners, Wedgwood Partners out of St. Louis, are running the fund day to day. They've been doing this for 16 years with a very, very consistent record of beating, the averages. That benchmark is the Russell 1000 growth, large cap growth stocks. The financial ETF, the benchmark is clear. We're going to try to beat on a consistent basis the XLF, which is the index fund, which is the S&P 500 financial sector. And the same thing in the technology space. We want to beat the NASDAQ. We want to beat, we're getting paid to beat the market and to beat those indices.